All right, I think we'll go ahead and get started. Thank you to everyone for joining the presentation today. We're going to be talking about Epichem's drug discovery in Australia's R&D tax program, what we call a great partnership opportunity. And it is my pleasure to introduce Colin, Galia, CEO and Managing Director for Epichem. Colin?
Thanks, Steve, and hello everyone, and thank you very much for joining us. So I just wanted to give you a brief introduction on Epichem. So if Steve, you could just change the next slide, please. So Epichem started in 2003 with two major objectives in mind. The first one was to meet an unmet need at the marketplace around the need for medicinal chemistry, and also to provide employment opportunities for PhD graduates who at the time were being lost to overseas positions, or they were becoming baristas in a cafe, and probably more recently Uber drivers. So fast forward 18 years, we now have two purpose-built state-of-the-art laboratories here in Technology Park in Western Australia, and we employ a very large team of PhD qualified and postgraduate chemists across three major disciplines: medicinal chemistry, synthetic organic chemistry, and analytical chemistry expertise. Epichem is also a registered research service provider and an Australian-based contract research organisation, and I'll touch on more of those throughout my presentation. Thanks, Steve. So Epichem has 5 divisions of its organisation. So the first one is what we call synthetic and medicinal chemistry. So this is our drug discovery, drug development and drug design arm, where we work with a very large cohort of our global clients. Our second division is what we call pharmaceutical reference standards. So this is the division of the organisation where we work with organisations that are moving their products from patent to off-patent or generics, or those moving from prescription to over-the-counter medication to develop their reference materials for replication of those products moving forward. The third division is custom synthesis. As the name would suggest, we get a lot of requests to make molecules and compounds by design, and bespoke recipes at that. The fourth division is called analytical chemistry. So that provides not only an internal resource within the organisation around QA and QC, but also has its own external client base and revenue generating arm. It also includes clients outside the life science and biotech space, including mining and oil and gas clients as well. And finally, the fifth division is called material science. So this is where we do method development and consulting to accelerate commercialization of our clients' IP, to help them realise the opportunities with their asset and their technology. Thanks, Steve. So Epichem is certified to ISO 9001, and we're also accredited to ISO 17025 for laboratories and 17034 for reference standards. I'm happy to share with you, we're also recognised as one of the top 10 employers of choice for PhD graduates. And we've also been recognised on a number of occasions as national and state export award winners, the most recently being the 2021 Export of the Year for International Health, an award that we won 4 out of the last 5 years. So we're very proud of our achievements as an organisation during this time. Next, please, Steve. So I just wanted to share with you a bit about our vision to be the chemistry provider of choice, and to deliver world-class, innovative and high-quality solutions for our client base. I'm happy to share with you that currently 80% of all of Epichem's products and services are exported to more than 40 countries worldwide, with the US being the largest market, followed by Europe and Western Europe, and then Asia Pacific with some of the more mature markets of Australia, New Zealand, Singapore, South Korea and Japan. And it's important for us to be true to those values of expertise, quality, and so on as we work, as you can see on the slide there as well. Service and technology is a big part of what we do. Next slide, please. I'll talk about some of our medicinal chemistry expertise. I won't go through every point on this slide, but this slide deck will then be shared with the audience after this call. But we talk about hit to lead projects, lead optimization towards candidate selection. We can do scale up, IP generation for clients. We can also do project management, and we also have very effective, but both fee-for-service and full-time equivalent contract options available. And we have a full range of high-end quality equipment to carry out our chemistry expertise. Thanks, Steve. So there's a number of ways that we can work with clients. So we can look at moving from synthetic chemistry to medicinal chemistry to project integration. So we can get from client lists of compounds, we can do everything from analog preparation to shipping and storage. From a medicinal chemistry point of view, we can go from the client to a lead molecule request. And then we can also go from a project integration perspective to a full client discovery program. And I'm happy to share that over the last 18 years, we've done a lot of those right across the board. Next slide, please. So these are some of our types of chemistry, our areas of expertise, and our reagents and reactions that we can conduct. This is not an exhaustive list, but one that gives you an idea of the breadth and footprint of Epichem in terms of our chemistry capability. The examples I can share with you that are in the public domain is with an international customer called DNDI, Drugs for Neglected Disease Initiative. Epichem has had a 13-year consecutive relationship with DNDI, looking at the area of infectious diseases in that project. And I'm happy to share that the Epichem team delivered more than 500 molecules for the client last year. And another organisation you may be familiar with is PYC Therapeutics, both listed on the ASX and NASDAQ. And we work together in partnership and collaboration to develop a solution for retinitis pigmentosa, which for most of you, you'll be aware that if left untreated, the patients run the risk of going blind. And we're happy to say that we accelerated commercialisation of that technology in partnership with PYC. Thank you, Steve. Next slide. So this gives me the pleasure of introducing our guest speaker for today, Andrew Barker. So welcome, Andrew. Andrew is a senior manager with RSM Australia's R&D Tax and Government Incentives Group. And they have national responsibility for biotech, pharma and medtech clients. And in addition to advising clients on accessing the R&D tax incentive, Andrew also provides sector-relevant technical support to the corporate finance and risk advisory team. So I will hand over to Andrew, who will no doubt speak more about the R&D tax program in Australia. And then following the presentation, happy to answer any questions that you may have. So I reached out to Andrew and he kindly accepted the opportunity to present to you today on the Australian R&D tax program. What are the benefits for the program and what you need to be aware of if considering setting up an entity in Australia. So welcome, Andrew.
Thanks very much, Colin. And Steve, next slide, please. So for those of you in North America, you may already know RSM. You may also remember the former name of the entity in the United States, which was McGladrey LLC. Next slide, please. Steve, we can probably just skip over. Colin's already done a perfect introduction to that. Next. So just please be aware, sorry, could just go back one. We do show a disclaimer and actually talk to it. Unlike most stockbrokers, it's just please be aware that this is general advice only and that for your specific circumstances, we strongly recommend that you seek the advice of a professional before you act. Next slide, please. So there's a lot of talk about Australia's R&D tax incentive, not all of which is necessarily reflecting the what is actually available to you as a specific claimant. And we find that particularly in an Australian setting, even that particularly for small companies that have come out of been spun out of an academic setting, that there's some misnomers around. So first of all, I mean, I think people in North America will understand what a tax credit is, that the tax incentive is something slightly different. And that is that it's a tax offset. And I'll go into this in more detail in a minute, but I just want you to be aware right from the start that we're not talking about a tax credit. There are circumstances where you can actually get money back through the scheme. The other thing about this scheme, which is important in an Australian setting, is to note that it is an entitlement. If you meet eligibility requirements, you will get money back. There's no cap on the amounts that are given out under the scheme. It's not like a competitive situation, first in, best dressed, or that which those who can make the strongest case. If you meet eligibility requirements, you are entitled to receive the money. Under those, just to go from there a little bit more, Australia's tax scheme operates under the principles of self-assessment. So you determine, there is a chance that you will be reviewed by the relevant authorities, but it is ultimately up to you to self-assess. So in most circumstances, it is not that somebody has said that what you're doing is eligible, it is that you have self-assessed to do that. Once again, just to make sure that we're very clear that what it is not, the other thing that you'll hear a lot is that it is not a grant. Grants in Australia, and I think most other jurisdictions, are taxable income for a tax-paying entity. The R&D tax offset is not. Next slide, please. So what the scheme enables. So again, looping everything back further on, for eligible entities, the tax incentive, if you meet the requirements which are underlined, which is essentially, first of all, that you need to be an eligible entity. Second, if your group turnover, and I'll define that in more detail in a minute, is less than 20 million Australian dollars, then you're entitled to an offset of currently 18.5% in addition to the prevailing company tax rate. So if you're in a pre-tax payable position, if you have got clear tax losses, you actually then get a tax refund of 43.5% currently. That is only going to change if the corporate tax rate changes. If you don't meet those requirements, you'll find that this is often the case for, as I said, for certainly for larger companies, there's a two-tiered non-refundable tax credit available. So in this case, it is a carried forward loss that you can use to offset against current or future tax liabilities. So if this is, however, subject to an intensity test, so if 0 to 2% of your company's total expenditure, and that isn't the group, that's just the taxpayer, is eligible R&D expenditure, then that attracts an 8.5% after-tax benefit. All additional R&D expenditure attracts a higher rate. So next slide, please, Steve. So I've just got a little illustration of this. Please ignore the 13.5%. The figure hasn't been updated, and that relates to a previous benefit that was available. Should now be 18.5. But it just illustrates the asymptotic nature that by the time your intensity reaches about 15%, you are very close to the full 16.5% non-refundable benefit. So for a company that is, I mean, the example would be a large pharma that was did not have significant sales in activity, but they were grouped with an overseas entity, so they were in the non-refundable space, but they were spending a very high percentage of their eligible R&D in Australia on R&D, then they would be very close to that 16.5% benefit. So almost as good as the refundable, presuming that there's also going to be some sales there that they can offset that against. Just without going into too much detail, I think rather than give an exhaustive presentation, which would probably take me about a week, I thought I would focus today on issues that are going to be particularly relevant for overseas companies looking to set up in Australia. So there are just some terms that we will need to mention quickly. First of those is clawback, so that if you receive a grant that you can still, so there's, if you receive a government grant in Australia, you can still claim the related expenditure. It's just that there will be an adjustment basically to prevent double dipping. That will mean that you can still get a benefit. It's just not going to be as big, and there's a complex little calculation around how we actually work that. Similarly, for feedstock, eligible activities can happen in a production environment, but if you're generating marketable goods, I mean, obviously for any company that's in the process of developing small molecule pharmaceuticals, they won't have any regulatory authorization to sell those products because they're still in a preclinical or clinical development phase. The goods are not marketable, so this won't apply. But if it does apply, similarly to the clawback, there's an adjustment so that you still get a benefit for the related expenditure. It's just not as big as it would be otherwise. The next issue, which is probably one of the critical points to develop later on, are the rules around for whom is the R&D conducted. So there are so-called on-own behalf provisions, and this is just to make sure. I see there's already been a question about IP ownership, which I'll think Colin will be much better placed to answer than I have. But basically, if you are conducting R&D on your own behalf, so if you're directing Epichem to do specific experiments, then you are the eligible entity if as long as you can satisfy these conditions. The rules are somewhat more relaxed for companies that are the subsidiary of overseas entities than they would be for an Australian founded company. But again, I'll run into that a little bit more below. There have been some recent changes to the legislation which govern this, and sort of the most disquieting of these has been the fact that R&D claims are from 1 July next year to be disclosed on the R&D's, on the ATO's, the Australian Taxation Office website. Normally the ATO, I'll have to use that acronym from now on, that normally treat everything with extreme confidence. They won't disclose, I mean, to the point that we can't even get reliable figures on the whole of scheme. But this one measure has been brought in. I think it's going to be interesting to see if there are legal challenges to it, but I'll just leave that out there, that the chances are that as of next year that this is going to, that any claimants are going to be publicly identified. Thanks, Steve. So getting back to some of those definitions that I flagged, what is an eligible entity? So the definition is that any claimant has to be an R&D active entity, and that will be dealt with shortly. The next precursor is that that entity has engaged in eligible activities in the income year in question. Please note that the Australian tax year normally runs from 1 July to 30th of June. So we're currently in financial year 2022. There are possibilities, if you can mount a case, to have a substituted accounting period, and some North American firms with Australian subsidiaries find it convenient for the Australian subsidiary to have a December report. Some of our clients have even set it up so that their reporting year ends on the 30th of September, giving them 3 months for their tax affairs to be finalised in Australia, and for that to then feed back into the parent company. Matters for your tax advisor when you engage one. Now, the other thing that is absolutely critical is to be able to claim is that not only that you've conducted eligible activities, but that you can identify eligible expenditure. And there is a threshold. To be able to claim, you ordinarily need to have spent at least 20,000 Australian dollars in the year to be able to claim. Obviously, most claimants will have spent a great deal more than that. Now, one point which we can't hammer enough is that the onus is on the claiming entity to retain the supporting evidence. Now, there is no precise legal definition of what this supporting evidence is. there is, because the scheme has only been around since 2011, there is not yet a great deal of case law around that. The ATO has its position. We would generally, for example, and I think most other providers would generally try and get you to make sure that you have adequate evidence. Anybody who is conducting experiments that are precursors to clinical trials will have sufficient supporting evidence. It's just a matter of making sure that that's identified. Next slide, please. So an eligible R&D activity. So an eligible project must contain at least one core activity. And so a core activity is defined in legislation. And the definition is that the activity is experimental. The outcome cannot be known or determined in advance. So, for example, verifying that producer B's enzymes produce a comparable outcome to producers A's enzyme in a diagnostic test is not something that cannot be known or determined in advance, but is not conducted for the purpose of generating new knowledge. So anyhow, so that it's experimental, you don't know what the outcome's going to be, and it's conducted for the purpose of generating new knowledge. And then also the other thing which has probably been less intensely pursued by the regulator, but which we're starting to see more of as the scheme's been around for longer, is that all of that can only be determined by systematic progression of work, is based on principles of established science and proceeds from hypothesis. So we always look to have a hypothesis statement. Then the hypothesis leads to an experiment. There are results from the experiments which you evaluate, and then from those evaluations you draw logical conclusions. And so we're always, in the technical summaries that we're providing to the regulator as part of this scheme, we're always looking to establish that flow of work. And then obviously if subsequently there is additional work required based on the logical conclusions, that then leads to the ongoing systematic progression of work. Next slide, please. So eligible expenditure. Certainly for small companies, we'll find that typically, and also for large ones, that a lot of the eligible expenditure is tied up in wages and salaries, and that includes, Australia has what we call superannuation, is basically a compulsory pension scheme. It's so an employer is obliged to spend 10% or to pay 10% in addition into a designated pension fund for each employee, and then there are also some other, so workers' compensation insurance, and there are state payroll taxes that also fit under that umbrella. Obviously, items directly related to the R&D activity. So if you're purchasing materials to conduct, or if you're paying fees to a hospital to conduct a clinical trial, et cetera, those would fall under that bucket. Contract expenditure, so fees that you pay to Epichem to conduct R&D on your behalf, would fall under contract expenditure, and of course other contractors. So if you had, for example, in a clinical trial monitors would fall under that. Then Colin's already mentioned that Epichem is a research service provider, a so-called RSP. There are real advantages under the tax incentive for engaging an RSP, because this lessens your burden of documentation, because to become an RSP, Epichem have satisfied the regulator that they keep sufficient documents on hand. So that means that greatly lessens your burden. The other advantage for a very small company is that $20,000 threshold that I mentioned disappears if you're with RSP expenditure. Although if you're spending less than $20,000, I think you're probably not really interested in going to Colin to do that. Depreciation on plant and equipment used in R&D activities is available if if this depreciation is under normal provision. So I don't want to get further into that discussion, just to say that depreciation in Australia is not simple. There are accelerated provisions that are available under varying circumstances. In fact, the rules have been relaxed for the current and I believe the next financial year, so that if you come here and you set up a lab alongside Epichem's, and then you can actually claim that depreciation in an accelerated form. But that's only a temporary measure related to COVID. Other expenditure directly related to R&D activities, I think we've already covered that. I mean, there's things like travel that would be if you're travelling to, or if you're giving a presentation that you're going to use attendee feedback to direct the future of your experiments. Any of those experimental work, any of those sort of things will be allowed. And then also a proportion of overheads. So that would be things like if you have an office that the rent that you pay, your phone bills, there's various things, utilities, that can be apportioned. Now that apportionment, and this is one of the reasons why the ATO has been so so specific at making sure that people are keeping adequate records, is that is typically based on the percentage of employee time spent on R&D as opposed to total time. And for that reason, we're typically looking at keeping timesheets, so that you would have a weekly number of hours spent on a R&D activity divided by the total number of hours worked. And then over the company, that percentage is what allows, is the rate at which indivisible overheads are apportioned at. So very important to keep the appropriate records. Now, one little thing to note here is that for technical reasons, for example, I mean, if a population of individuals, let's say that you wanted to test a drug in a African American population, specifically for a technical reason, there's not sufficient numbers of people available to do that in Australia. You can therefore actually claim that related expenditure as well, subject to obtaining a so-called overseas finding. Now, just putting that out there and then pulling it back again, because going to the effort of obtaining a finding is not a trivial exercise. That will be quite expensive. It's generally not worth your while if you're looking at less than approximately $500,000 Australian dollars in expenditure on that work. And it does open you up, unlike the self-assessment that I mentioned above, it does also open you up to the regulator actually specifically looking at what you're doing and then making a legally binding finding on that. So it's not an exercise for the faint-hearted. Next slide, please. So getting back to an R&D entity. Very simple definition. Basically, it's a corporation. So it's an incorporation either in a company that is incorporated in Australia, but there are possibilities for foreign companies to meet the R&D entity definition without being incorporated in Australia, and that is if a foreign corporation is an Australian resident for income purposes, or a foreign entity that is a resident of a country with which Australia has a DTA, and that which includes a definition of permanent establishment. The United States is a country that meets that definition, and carrying on business in Australia through a permanent establishment as defined in the DTA. So that I don't want to go further into that, but there are little niceties around each of those, which we will touch on again in a minute. Please note, however, that regardless of the type of entity under those OR provisions, that the corporation needs to be a tax-paying entity in Australia. So if you're not paying tax here, you're not eligible. Again, Australian universities are typically non-tax paying because they're tax exempt, they're not eligible either. Next slide, please. The other thing which is probably a critical take home will be the grouping rules. So as I mentioned, the refundable tax offset is available to R&D entities for whom the aggregated turnover is less than 20 million Australian dollars. So aggregated turnover is your revenue from normal business activities. So if you've got a very large amount of interest, that doesn't go towards that you're receiving, that doesn't go towards calculation. But the aggregated turnover is the annual turnover of the applicant plus any other entity with which it is connected or affiliated. Important thing here is that the threshold above which connected or affiliated entity becomes such is 40% ownership or the right to acquire. So if even for an individual who would be an associate, if someone held 38% of the total shareholding, but they had sufficient performance rights that would tip them over the 40% if they were exercised, then that person is an associate and then also has to be included in this. So this will be important if you're a startup and you have a 49% ownership from a hedge fund that has $1 billion revenue, that will push you way out of the refundable tax offset territory. Similarly, if your subsidiary has a majority ownership of a large pharma company, and then the other option which we have seen here, sometimes if some of the magnates, mining magnates around the place will be very generously putting money into small companies, but they take a 49% position, and then that also by virtue of their other revenue, that pushes the company out of the refundable offset territory. Similar, the rules are slightly different for university spinouts. The threshold there is 50%, not 40%. But otherwise, if you're in excess of that, you can still get a tax offset. It's just not a refundable one. Next slide, please. So on own behalf provisions. As I said, and this is again relevant to probably also relevant to a question about the commissioning a CRO. So you are eligible to claim if the activities have been conducted for the R&D entity, and there's some more definitions around that which will be on the next slide, or for the foreign corporation under the circumstances aligned out. The rules are actually slightly more relaxed for the foreign corporation. You don't need to go through the on own behalf, but you do need to be able to demonstrate that the foreign corporation. So if you contract Epichem to do some work, because they're an Australian incorporated company, they would not be able to claim, even if they could satisfy all the other on own behalf provisions, they would not be able to satisfy this definition because they don't control the, at least my understanding is they don't control the IP. Colin will get back to that later. However, if you set up a subsidiary here and the subsidiary does control the IP, then they can claim this. Sorry, the subsidiary doesn't need to control the IP if the parent does. So you don't need to relocate IP to Australia. There will, however, be tax advantages for doing that. Next slide, please. I'm expecting lots of questions around that because it's quite confusing. So for whom are R&D activities conducted, as I said, we go through the 4 test. And then there are these 3 conditions which apply to that. So the taxpayer has to have effective ownership of know-how, IP, or other similar results. If it's a foreign-owned subsidiary of a foreign corporation, if the parent entity controls the IP, then this condition is still met. So that's the relaxation I referred to. You are exercising appropriate control over the conduct of the R&D activity. So you're telling Epichem that you want them to develop a specific molecule, for example, then you are controlling the project. And then you are also that you are bearing the financial burden. So that what that means then is that they are not just charging you a fixed fee, but that you're actually paying them an hourly rate. So you're contracting them to do work on your behalf. The critical thing here is to make sure that you have appropriate written agreements in place. So the Australian subsidiary can contract Epichem on behalf of the overseas entity, but you do need to have written agreements in place with the overseas parent entity. Next slide, please. So factors that you will especially need to consider, and this is not just whether in principle you can obtain the refundable tax offset, is whether other factors that will influence the net benefit that is actually available to you. So important factors here. First of all, whether the IP is held in Australia or overseas, it does make a difference. You don't need to bring it here, but it will make it easier for you to justify making claims. The funding is quite important too. If you're providing, I mean, I'm not going to get into the details of this because I'm not an expert, but there are quite stringent approaches nowadays to transfer pricing rules. So a company will need to make if you're funding this from overseas by a loan from the parent company, you will need for the Australian company to make a small profit for tax purposes in Australia. I mean, I can't, because of the general confidentiality requirements, I can't identify specific clients, but I've just got one open who we've dealt with this problem, and so they basically needed for approximately a $700,000 expenditure, they needed to make a small profit, so they ended up saying that they've made a profit of about 20,000 Australian dollars with some other unrelated costs, so their total expenditure was about their total expenditure was about 750,000 Australian dollars. Their revenue was $770,000. Now, for previous year, where the corporate tax rate was slightly higher, so the amount will be somewhat better. They've ended up with an approximately 15.2% net benefit, so slightly less than the 16.5% that was available, and we're not counting the tax rate. The other issue that they've had to deal with was the fact that because they were a permanent establishment and not incorporated in Australia, that they also had to pay withholding tax in Australia, which is about 10%. So that just meant that the benefit, rather than looking at that full 43.5%, it's actually a bit less than the net benefit minus the corporate tax rate. If you set up I mean, another example we've seen is where an overseas company has set up a subsidiary in Australia, and they've actually raised the capital in Australia to fund it, and they have been able to claim the full 43.5%, but they were also looking at conducting early phase clinical trials here subsequent to the preclinical work. This puts them in. There are other reasons for doing that, which I won't go into because we aren't clinical trial regulatory affairs experts, but there are certainly valid reasons for doing that. And then on top of that, the overseas tax, the tax incentive just happens to be a nice benefit that they've been able to get to. So particularly the particularly sharp issues come if the overseas parent seeks to repatriate the benefits. If you are looking to just spend some money here and then claim the tax incentive and take all the benefit back to Australia, that will be taxed, and you'll find that the benefit is much smaller than would be available if you were seeking to then spend more money, as I said. Next slide, please. Just to run a little bit through how the process actually works. The lodging a claim is actually a two-stage process. So first of all, you have to provide a registration, so-called registration application to a body called Oz Industry, who allegedly contain technical experts who can verify that what you are claiming is eligible R&D is. This is basically a summary of how the work, what you've conducted, how it meets eligibility requirements. They will provide you, once they're satisfied, or if they'll generally give that a fairly cursory review. They will then provide you with a so-called registration number, which you then put into the relevant portion of your tax return and include a expenditure claim. As your advisor will go in some detail through that with you, how you calculate that. That's then included in the company tax return, and you will then receive in the fullness of time either a cash refund or a tax credit, depending on circumstances. There's a lot more around that. I'd suggest that if you are considering going through this process, that these will be conversations that you'll need to have in a lot more detail. It is just to give you an idea of the fact that it can take a while. So from lodging a registration, typically Oz Industry will take up to 2 weeks to give you the registration number, and then it's up to you to complete your tax return. Once your tax return's lodged, the ATO will normally aim to provide an outcome within a month, but they can take longer depending on the size of the claim, workflow, time of year, all those sort of things. The critical thing to note is that you need to lodge a registration for each year for which you wish to claim. So you can't use 1 year's registration for the next year's claim. You need to go through that process every year. Next slide, please. Just to point out once again, I mean, I hope this is all sort of self-evident, but Oz Industry and the ATO are completely agnostic about whether you engage a professional advisor or whether you do it yourself. We obviously would recommend that you go to an advisor, and also that you make sure that that advisor is both competent and shows integrity. The critical thing, however, regardless of who you engage, is to make sure that they are a registered tax agent. If they cannot provide you with a registered tax agent's number, then they are putting themselves at some risk of punitive action from the regulators, and anything that they tell you, you won't be able to rely on. So please make sure, if you do engage anybody, that they are a registered tax agent. Very, very critical point. Given the regulatory responses. Now, I think I've got one more slide. Just to wrap up, Australia has announced the introduction of a patent box, and so this would be for, if you're coming to Epichem to have some synthesis done, this would be another good reason to plan on not just coming to have a bit of work done and then clearing out again, but to actually stick around. So the priority date for patents was the 11th of May 2021. The difference between the scheme as proposed in Australia and every other country who have introduced such a scheme is that the Australian government has intended to restrict the patent box eligibility to so-called biotech projects, and they haven't offered a definition of what that is. Every other country that has incorporated such a scheme, there's over 20 of them, have been technology agnostic. It's available for any scheme. We're currently at the consultation stage. I mean, us and every other accounting firm is trying to convince them that it should be available to anyone that has a patent. But if you know anything about patent classification, you'll understand how fraught that can be to try and restrict it. But however, draft legislation is still gurgling through the system, hasn't yet been published, so we don't know what the final form is going to be. Just a space to watch. Okay, next slide, please. So that's the end for me for now. Please, any questions? We are more than happy to attempt to watch. I see there's a couple up there already. I think I'll start off by letting Colin go to that first one.
Yeah, and thank you very much, Andrew. So the first question we've got from the audience is, if IP is developed by Epichem for a sponsor's project, who owns the IP and will there be any royalty fees due to Epichem? Quite an easy one for me to answer. The IP stays with the sponsor. We will be a service. We'll be a service provider. So from that perspective, we always, I mean, when we look at receiving feedback from our clients over the last 18 years, apart from the quality of the chemistry, they also engage Epichem because to protect the intellectual property, and also to make sure there's no unknown or unwanted replication of the work. So one thing I can share with the audience today is Epichem does not outsource any of its chemistry services or expertise. They're all done by in its entirety by the team here at Epichem in Australia. So once again, the IP remains with the sponsor or the client. So I hope that answers the question. And thank you very much for sending that through. I think the second one, Andrew, probably sits with you. The question was, someone asked, did I understand correctly that if a company commissions a CRO to make something, thus a known outcome, it would not be eligible for the tax benefit?
Yes, the answer is it depends. The long answer is, so just for the interest of time, activities that are not a core activity, but which are still essential for conducting a core activity, are also eligible. So in this instance, you know, for example, if you're seeking to conduct a clinical trial in Australia, that you are going to register, and Epichem is making the API for that clinical trial, then the fact that that synthesis is supporting the core activity, because you can't do the clinical trial without the API, will make it eligible. But you just need, it's a little bit more complex. You just need to be able to link it to an eligible activity. If you yeah, I'll probably just leave it at that for now.
Thanks, Andrew. We've got another couple of questions just come through. So next question was, does Epichem have experience in making prodrugs? The short answer is yes. With regards to providing expertise or examples, I would suggest if you could please reach out to us after this call, and I'll put you in contact with our head of chemistry and principal chemists, and they'll be able to give you the more of the technical expertise and specifics, including examples of where we've done this work. Another question we have here is, what type of collaboration models does Epichem offer to support outsourced chemistry support, fixed fee, time and materials, or FT support? So as I mentioned in my initial introduction, most of our clients are on FT models. Why is that the case? Because when you are a client and you're managing your budgets and your costings, what it means is that there's a fixed fee per FTE. So it means that you can manage your budgets accordingly and there's no surprises. So Epichem provides an all-in fee, including all starting materials, reagents, and all encompassing. So there's no surprises. So even though the goal is set, the plan may change, which means depending on the chemistry, if you as the client decide to change direction or the plan, it means that you don't incur any more costs because that's already been predetermined. So that's a model that we have introduced many years ago, and just by our client base globally.
Yeah, just to jump in there quickly, that aids your eligibility because it helps you to satisfy the 4 tests that I mentioned.
Yeah, no, thanks, Andrew. That's a good point. And then one of the last questions I've got in here is what percentage of Epichem's clients come from the US versus the rest of the world? That's as high as 70% at the moment. So during the height of the pandemic, and we were lucky enough to not have to close for a single day, we were able to support a lot of our US colleagues, both in terms of their labs and the universities being shut, and obviously more recently with some of the other countries in Europe and also those in the eastern seaboard of Australia from that perspective. So I think that's a great opportunity for those who are interested in medicinal chemistry. Please don't hesitate to reach out, and we're more than happy to have a discussion. And I think I've got one.
Sorry, Colin. If you don't mind me
Sure.
leaping in there again, there is also an early phase specialist clinical trial facility in Perth. For those who are interested, Western Australia is one of the few places that has remained COVID free. So they've actually been run off their feet throughout the pandemic. But again, somewhere between 70 and 80% of their clients come from the United States. And most of the rest, probably 20% rest of the world, 10% Australia.
Thanks, Andrew. That's really good. And then another question just here that's just arrived in the inbox is, does Epichem currently work with clients which receive tax incentives as a result of working with Epichem? And the short answer is yes, most definitely. We have a large cohort of clients right across the globe, and a large proportion of those who have been made aware or we have had the opportunity to put in contact with tax advisors like RSM, for example, have been able to set up entities and subsidiaries and then take advantage of the R&D tax scheme. I'll just pause there to see if there's any other questions. So one just come through. Has Epichem's work been submitted in US regulatory filings for approved products? The short answer is yes. Thanks for that question. So I'll just pause there to see whether there's any final questions before handing back to Steve to wrap up. No? Okay, so what I'm going to say is, first of all, I'll hand back to Steve, but Andrew, thank you very much for your generous time today. And I hope that has answered many of the questions the audience may have, and I'll hand back to Steve.
Thank you,
Yeah, thanks
Colin.
very much, Colin.
And thank you, Andrew.